Welcome back, dear students and scholars. We continue ASC 260 with the if converted method for diluted EPS. In the previous video, we handled options and warrants through the treasury stock method, where the numerator usually stayed unchanged. Today, we move to convertible securities such as convertible preferred stock and convertible debt. These instruments are more powerful because conversion can affect both sides of the EPS fraction, earnings and shares. Here is the 5-step path for this lesson. First, assume conversion. Second, adjust the numerator. Third, add the conversion shares to the denominator. Fourth, rank the securities by their incremental EPS effect. Fifth, stop when a security becomes anti-dilutive. This sequence matters because diluted EPS is not built by throwing every potential share into one big basket. We add instruments carefully, test each step, and exclude anything that improves EPS. Convertible securities matter because one instrument can change both the numerator and the denominator at the same time. If convertible preferred stock is assumed converted, preferred dividends may be added back and common shares are added. If convertible debt is assumed converted, after tax interest may be added back and conversion shares are added. That dual effect is why the if converted method needs more discipline than the treasury stock method. The method can be remembered in one line. Remove the old security effect, add the common share effect, then test dilution. For preferred stock, the old effect is the preferred dividend deduction. For debt, the old effect is interest expense. The common share effect is the conversion shares, but the instrument is included only if the final effect reduces EPS. Conversion is assumed for calculation, but inclusion still requires the dilution test. Timing is the next control point. If the convertible security was outstanding at the beginning of the period, assume conversion at the beginning of the period. If it was issued during the year, assume conversion on the issue date. That means both the numerator addback and the conversion shares may need time waiting. Do not automatically give a mid-year convertible a full year effect. For convertible preferred stock, the numerator adjustment is the preferred dividend addback. Why? Because if the preferred stock had converted into common shares, the preferred dividend would not have been deducted in computing income available to common shareholders. At the same time, the denominator increases by the common shares that would be issued on conversion. Both effects must be considered together before deciding whether the security is dilutive. Now look at the preferred stock example facts. Preferred dividends are $30,000 and conversion would create 15,000 common shares. Before putting this security into diluted EPS, isolate its incremental effect. This keeps the ranking clean. The add back and the shares are separate inputs, and the ratio between them tells us how dilutive the security is compared with other potential common shares. The preferred incremental effect is $30,000 divided by 15,000 shares, which equals $2 per share. This is not the final diluted EPS. It is the per share effect of adding this specific convertible preferred stock. If the current diluted EPS at the point of testing is above $2, adding this security reduces EPS, so it is dilutive. If the security would raise EPS, it is excluded. Convertible debt follows the same broad conversion logic, but the numerator addback is after tax interest, not gross interest. If the debt had converted, the entity would not have incurred interest expense. But because EPS uses income after tax, the addback must also be after tax. The denominator then increases by the number of common shares issued on conversion. The after-tax interest step is a common exam trap. Start with gross interest expense, then multiply by 1 minus the tax rate. For example, with a 25% tax rate, multiply by 0.75. The reason is matching. The numerator is based on net income, which is after tax, so the interest addback must be measured on the same after-tax basis. Gross interest would overstate the numerator addback. Now read the debt example facts. Interest expense is $60,000, the tax rate is 25%, and conversion shares are 30,000. The first step is not dividing 60,000 by 30,000. That would ignore taxes. The first step is tax affecting the interest expense. 60,000 multiplied by 75% gives an after-tax add-back of $45,000. The debt incremental effect is $45,000 divided by 30,000 shares, which equals $1.50 per share. This number is lower than the preferred stock effect of $2 per share. That means in a ranking sequence, the convertible debt enters before the convertible preferred stock, assuming both are dilutive at the point they are tested. The control number is income from continuing operations available to common shareholders. This is the benchmark used to test dilution. We do not test dilution casually against whichever income subtotal looks convenient. The control number keeps the diluted EPS decision consistent, especially when discontinued operations or unusual components could distort total net income. The same control number logic applies across the potential common shares being tested. Now we reach the ranking rule. Potential common shares are ranked from the lowest incremental EPS effect to the highest incremental EPS effect. The lowest effect is the most dilutive and enters first. Options and warrants often have a zero numerator effect under the treasury stock method, so when they are dilutive, they normally enter before convertible securities. Ranking is based on the per share effect, not the biggest instrument name. Ranking matters because a security that looks dilutive by itself may become anti-dilutive after earlier securities are included. Start with basic EPS, add the most dilutive security, recompute EPS, and then test the next security. If each addition reduces EPS, keep going. If adding the next security increases EPS, stop. This is not just a presentation order, it controls which securities survive the diluted EPS calculation. Here are the example facts. Basic EPS is $6. Options have an incremental effect of $0. Convertible debt has an effect of $1.50. Convertible preferred stock has an effect of $2. Do not combine them yet. First sort them from lowest incremental effect to highest incremental effect. That ranking determines the order of entry into diluted EPS. The correct order is options first, convertible debt second, and convertible preferred stock third. Options come first because their incremental numerator effect is zero. Debt comes next at $1.50. Preferred comes last at $2. Notice that we did not rank by the number of shares, face amount, or the size of the add back alone. We ranked by incremental EPS effect. Now apply the ranking step by step. Basic EPS starts at $6. After options are included, EPS decreases to $5.71, so options are dilutive. After debt is included, EPS decreases to $4.78, so debt is also dilutive. After preferred is included, EPS decreases to $4.50, so preferred is included too. The final diluted EPS is $4.50. The stop rule is strict. If adding the next security decreases EPS, include it and continue. If adding the next security increases EPS, exclude it. Do not include it partially. Do not skip it and test later securities out of order. Because later securities have higher incremental effects, they will not become more dilutive after a lower rank security fails. Diluted EPS must never be higher than basic EPS. In this anti-dilution example, current diluted EPS at the testing point is $5.20. The next security has an incremental effect of $8 per share. Adding a security with an $8 effect would improve EPS instead of reducing it, so the security is anti-dilutive. It is excluded from diluted EPS, and the remaining lower rank securities are also excluded. Presentation discipline is the final piece. Basic EPS and diluted EPS remain separate line items. Basic EPS uses actual weighted average common shares. Diluted EPS includes only dilutive potential common shares after applying the treasury stock method, the if converted method, ranking, and anti-dilution testing. Anti-dilutive instruments are not included in EPS, although material excluded instruments may be disclosed in the notes. Now take a moment to rank these three securities. Options have an incremental effect of $0. Convertible debt has an effect of $1.80. Convertible preferred stock has an effect of $2.40. Your task is to sort them from most dilutive to least dilutive. Remember, the lowest incremental EPS effect enters first. The correct ranking is options first, convertible debt second, and convertible preferred stock third. The trap is ranking by share count or by familiarity. A security with more shares is not automatically more dilutive, and a larger add back is not automatically less or more dilutive. Always divide the add back by the conversion shares first, then rank by the incremental EPS effect. That completes the if converted method and the ranking sequence. You can now handle preferred dividend add-backs, after-tax interest add-backs, conversion shares, timing, control number testing, ranking, and the anti-dilution stop rule. In the next video, we finish ASC 260 with advanced EPS issues, two-class method, disclosures, and practice. If this lesson helped you, please like the video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building this US GAAP course with clarity and exam value.